All right, can everybody hear me? Hear me?
Yes.
Perfect. All right, so hello everyone. Actually, very excited to be presenting for you today. For this current holdings presentations, we're going to be talking about Starbucks, ticker symbol SBUX. My name is Steven Rodriguez, and I'll let my group members introduce themselves.
I'm Isabel Odutola, and I'm a junior analyst.
And I am Robert Alfonso. I'm also a junior analyst.
And we're going to get right into it. And for those of you who may not know who Starbucks is, they do belong to the restaurant sector, and they are the premier roaster, marketer, and retailer of specialty coffee in the world. They do have three operating segments, which are the Americas, International, and Channel Development. And their main sources of revenue come from their company-operated stores as well as licensed stores. And then they have an other revenue section, which is why you would see Starbucks products in grocery stores as well as wholesale clubs. And they do offer a variety of products such as coffees and teas. And then their food is going to range from breakfast sandwiches, lunch sandwiches, to bakery items such as pastries and cakes and all that stuff. And it's also important to notice that Starbucks has licensed stores, not franchise stores, as a way for them to create and share their culture across their stores, across the board, and creating the Starbucks experience for each customer that walks into one of their stores.
Starbucks is one of the leading beverage companies in the world with an enterprise value of $118 billion. They have shown strong resilience against negative changes in the market in the past 24 months. In comparison to competitors such as McCafe and Dunkin' Donuts, Starbucks has managed to stay ahead of revenue growth by consistent quality service and expanding into the markets within their reach. Starbucks also has an immense amount of retail stores across the country and worldwide that continues to grow yearly.
So moving to a quick summary of our thesis. Currently, SMIF owns 53 shares of Starbucks. That is about 1.6% of the entire portfolio. Our cost basis is $2,989, and as of Monday, we had a net gain of $1,130. So just going to share some quick points of why we think this company is a hold. So there is room for the company to grow. The industry is expected to grow for over 10%. We're going to go more in depth about that in the next slide. The company is trying to expand its menu items and plans to hop on the impossible foods trend. It's also looking into the expansion in current and new locations, that is overseas and here in the United States. And because we already have a very well established position in Starbucks, we consider it a hold. If you take a look at the right, on the upper right side of the slide, you can see that since 2014, on average, the revenue has grown by about 10% for Starbucks.
Just as Stephen mentioned on the previous slide, there is an opportunity for Starbucks to grow not only internationally, but as well as in the US. And if you take a look at the map, as you can tell in the Northeast region and the Southwest portion of the United States, that's where many of their stores are located because they choose to place their stores in high traffic areas. And once they're able to locate those places, the high traffic areas in the Midwest, they will expand more stores to there. And it is important to know that Starbucks has jumped onto the impossible trend this year, introducing their first impossible sandwich. And as that shows good feedback, they'll add more products along the impossible chain as well. And they have switched over this past month in September from straws to strawless lids, which is their way of showing their sustainability. And an article in 2019 from Bloomberg said that companies who practice more sustainable efforts do much better in terms of stock compared to their peers. And an article in 2020 from Barron's reiterated that same idea and also mentioned that companies who do participate in sustainable practices were able to come out of the pandemic stronger and are coming out of the pandemic stronger than their peers.
Right, so briefly covering the earnings model, we expect Starbucks revenue to continue growing year over year, but actually pay attention, it's actually at a decreasing rate. The Starbucks operates from September to September schedule. The predictions for the last quarter of 2020, which is again finishes the September, were actually done based on consumer spending trends. Similarly, for the second quarter of 2021, we also use consumer spending, and we believe that that's the span of time in which Starbucks will grow back to the 2019 levels in terms of revenue. And we believe by 2024, we expect a PE ratio of $3.62. So finally, valuation and conclusions. So there is actually opportunities for the price to spike. We calculate fair price for the stock to be between $65 and $98. That is actually assuming that the company will experience similar PE ratios that it did in 2018 and in the bull run of 2019. The company has the proper revenue trend to maintain the growth and to maintain and grow the stock price. Now, this is actually very important. Management has a positive view on the company's future. It's been buying shares back since 2016. If you look at the chart on the right, you can see that Starbucks continue opening stores, and is no different this year. They actually came out and said that they were going to open about 100, a little bit over 100 new stores by next year. So besides the stock price, Starbucks pays a dividend, one that has been growing by over 10% year by year. It even saw 20% growth in previous years. And just with established positions, SMIF can capitalize in moderate price increases along with the fast-growing dividends. We would recommend that you should buy Starbucks if it falls close to the $60 range. Is there any questions?
Well, thank you. Great presentation. And just one thing I want to add, Professor Gar, I believe you're on the call. I totally forgot. Thank you for coming.
Sure.
And, sorry, I totally forgot. My chat was a little slow in popping up.
It's all good. I have a question though on this one.
Yeah, of course. I just want to say, if anybody has any questions, please try to hit the raise your hand feature. Unless you're a professor and advisor, otherwise jump in. We'll try to get as many as we can, but if we get a lot of questions, then we'll start prioritizing by people who are in the portfolio management committee. But go ahead, Professor Gar.
All right, sorry, I'll go quick. I thought this was a great presentation too. I have one quick question on the earnings model. It's a little small on my laptop here, and I looked at it, but it looked to me, you said that you had a 10% revenue growth number, but it looked to me, if I read it right, that you had a constant 14% operating margin, if I was correct. And I'm kind of curious if you think it's a hold right now, but if a big part of your story is new products, don't you think that might mean that we could see some expansion in gross margins in the beginning, but operating margins later on? That might mean that the earnings growth rate could really get going, combined with the fact that they're buying in stock. You think there's some operating leverage there?
Yeah, actually, I did consider maybe potentially saying that it would be a buy based on those reasons, because there is that potential for the price to spike. But I also consider that 1.6% of our portfolio is already Starbucks. The fact is, it actually is very dependent on the management. I think it would just really depend on if we really believe that the management will be handling, navigating these opportunities for growth properly. Because if they don't, then we're just going to be stuck in the continuous growth that we're currently seeing. Some other things that I did consider too for the 2020 approach, it's actually in the appendix on the portfolio, was how they were looking in cash, since they had a really rough year. Were they able to meet their financial needs, and is that going to set them back in the next year or so? And they're actually in a better position than what they were last year. It did seem that they got some short-term loans in there, but not over the top comparison to their peers.
Very good. Excellent work. And Luis, I don't see a hand up button on this thing. Is there a place I should be looking, or am I in here as a guest that doesn't have a hand up button?
I'm not exactly sure what you see on your screen, but where the mute icon is and the camera icon in that row, it should be, It might be under more actions.
All right, I'll figure it out. All right, sorry to bother you. Very good.
If not, just jump in. But Zach, I believe you have your hand raised. Go ahead.
Thank you, Professor.
Yeah, can you hear me, Luis?
Yes.
Thank you. Yeah, great job. That was awesome. Just one, actually two questions. One, do you know kind of where they're looking to expand, whether these are like franchise stores or more, or not franchised, but independently operated versus franchise, is the first question. Because you said they're building 100 more, is that correct?
That's right.
Okay. Do you know which are they leaning more like, is there any kind of idea as to what that's going to look like as far as a franchise store versus one of theirs?
Well, for the license operated ones, they're looking to expand more of those overseas and then more of
Okay.
the company operated ones in the US.
Awesome. Okay.
Yeah, actually, in 2019, they actually had this happen in which they had a deal in one of their license stores in China
Right.
and or over there in Asia. And what happened was that they brought it back to fair value, and there was a big difference, and they got that money back. So
Yeah.
I think they're actually looking into expanding over there as well.
Okay. And then the only thing I would say is to watch out for is that the Impossible. I'm trying to remember what company that is exactly. I know they Beyond Meat. That's who it is. I know McDonald's recently kind of let go of their I want to say it was like a year-long test run. Do you guys see that being a big part of their potential revenue growth moving forward? Is that Beyond Meat kind of alternative food options?
Yeah, well, you see, when in terms of culture, I think the culture is very shared for the coffee enthusiasts and the people that like the veganism and the vegetarian food options. I know that for a fact in that culture there is a big problem in which they don't have a one quick stop for vegetarian or vegan food, and that's what they're looking for, right? So Starbucks is actually something that they already trust in terms of their services and in that culture. But the one thing is, like, I know that Beyond Meat, as they go along and they, do the research and development, their products are actually going to be cheaper. And just establishing those connections from now on, it's probably a good idea for Starbucks.
Yeah, I agree. Awesome. Thank you guys. That was a great job.
Yeah, great job. We have time
Thank you,
for
Sam.
one more question. I believe Professor Hariharan has his hand up.
Yeah, I concur. Good job. One quick question. Why do you think that expanding in terms of number of stores is good for us? Because the last time they did, they really went overboard and then had to shut down a whole bunch of stores and bring back the founder.
Yeah, that makes a lot of sense, especially in places where they're highly populated, on the northeast and in the southwest. But there's actually this middle portion. I wish we'd still had the PowerPoint pulled up. There's this middle portion of the country where there's actually not a lot of Starbucks, right? So there's just a couple thousands, a couple hundreds. It actually infiltrating those markets is a great idea for the company. So I guess you're right. It's not in terms of how many stores they're opening, is where those stores are actually being opened. Since they're actually looking into expanding overseas, that's a good trend. And if they actually get to infiltrate that market, I know that they haven't done it probably because of consumer preference, but as they add more menu items, I'm sure they can tailor to those specific customer needs. Does that answer your question, Professor?
Yes, it does. Thanks.
Thank you.
All right, like I said, great presentation. We'll definitely be taking a good look at Starbucks at the portfolio management meeting. I know David will take a close look at that. Apple, go ahead and screen share and start whenever you're ready.
Can you guys see the screen well? Yes.
Can you minimize the picture of you? It's in the there you go.
All right, we're just gonna get started now. Hi, I'm Untitled. I'm a senior analyst,
And I'm Raul Alcantara. I'm a junior analyst.
and we're pitching a partial sell on Apple. Headquartered in Cupertino, California, Apple has the highest market cap of any public traded company and is a leader in the information technology sector. Apple is also incredibly popular among Americans, with 64% of Americans owning an Apple product, and extremely popular among the younger generation, with 84% of teens owning an iPhone. We feel this will lead to great long-term growth. Looking at the graph below, you can see over the last few years, the number of smartphone sales that were iPhone has experienced fairly steady growth. We feel over the coming years this will continue. Looking at Apple's revenue, you can see it's dominated by the iPhone, with 60% of revenue coming from it. Despite this, due to Apple's innovation, their other segments are starting to become another source of significant revenue. Looking at that graph to the right, you can see the rapid expansion of AirPods and the Apple Watch. We expect this growth to continue in coming years, as well as lead to more revenue in other segments. This will create a great supplemental income for Apple.
All right, we're going to look at the industry as a whole. There's high competition relative to product pricing, with many products like hardware, laptops, smartphones being very similar in prices. And overall, this leads to a limited industry revenue growth. From 2015 to 2019, there was a negative 0.4% industry revenue growth. And also, we do see a possibility of decrease in discretionary spending for this industry due to the virus and its effects going forward. And as well as products becoming more of a staple to consumers, with everyone making a switch to at-home work and school, making laptops, smartphones, and other necessities like that more of a necessity rather than a luxury. And here we can see Apple and its competitors, including HP, Dell, Cisco, and Intel. Some things to point out about Apple here, we can see that its market cap is sitting at $1.92 trillion and its revenue at $274 billion, making it the leader in its industry among its competitors. And also something else to mention, the PE trailing 12 months is sitting at 34, and we feel that's slightly rich at the given time. And we're going to look at the Porter's 5 Forces analysis. Going back, there's a variety of products among this industry. So again, there's a lot of competitive rivalry, which leads to a high focus on research and development with these companies, making sure their products are different from one another. And there's also competition stemming from Chinese manufacturers bringing in that competitive rivalry as well.
Looking at Apple's performance versus the S&P 500 in the last few years, you can see Apple has greatly outperformed the S&P 500, making over 500% in the past 5 years and over 100% in the past year alone. This is in the same time frame the S&P 500 has made around 60%. Despite this incredible recent growth, we feel this has pushed Apple past its fair valuation, and we expect more moderate growth in line with the market in the coming few years. One of the reasons we expect this more moderate growth is the expanding product life of smartphones. The average upgrade time is expanding from almost 23 months in 2016 to almost 25 months in 2018. This could lead to smaller growth in Apple's future. Although Apple could be hurt by this, they are somewhat safeguarded by the fact that some new upgrades and software are only compatible with new iPhones, as well as major upgrades to the iPhone still warrant an upgrade to many consumers.
Some things to know about Apple is its foreign cash distributions. In 2017, Apple nearly had $230.2 billion, or 94% of its cash held overseas. And this is due in part because if Apple brings in that money, it'll be taxed upon arrival and distribution, which will also lead to another tax for shareholders when they get paid out their dividends. So currently it's harder to calculate the actual cash Apple has in the US, but thanks to, in 2018, a GOP tax cut bill, it's been able to bring some of that cash overseas back to the US. And in turn, Apple's been able to buy back some more of its stocks, which is basically Apple buying back stocks, making the current shares more valuable and making more earnings per share, leaving investors with that. And then amidst the pandemic currently, Apple's still buying back stocks. When we look at our valuation, we used a discounted cash flow model. Despite the high amount of cash, there's still we see an intrinsic value of roughly $66. And this is due in part because some of the cash flow is questionable due to it being overseas.
Looking at our earnings model in our report, these are some of our growth analysis projections. We project Apple to have fairly solid growth in the coming years, but nothing that greatly outperforms the general market. We do project slightly higher growth in 2021 due to a 5G iPhone, as well as 2023 due to an increase in consumer spending. That being said, we do not feel Apple's future revenue justifies this current valuation, but we do feel it'll have significant long-term growth for several decades to come. Overall, we feel the market is currently overvaluing Apple due to the technology hype the virus caused. With a market capitalization more than twice as high as a year ago today, we feel this is pricing in a great deal of future growth, as well as a continued work from home narrative. We feel this creates a selling opportunity for us as a long-term holder and a chance for us to capture profits on a currently overpriced equity while trimming our position back to a more moderate size. By selling 49 shares or 35% of our position, we trim our position from around 6 to 4%, which would still be one of our biggest positions. That way we can continue to get exposure to this industry leader while providing us with an opportunity to use those profits to explore some other opportunities. Thank you, Ron. Are there any questions? I believe Mr. Gar has a question. Yeah, go ahead.
Yeah, I think this is a great presentation, and I think your logic is sound. I mean, this is the most overanalyzed company in the universe. So I can give you 45 reasons why everything you said is right and 45 reasons why somebody would go the other way. But my job is just to go through the numbers. And the only thing I would ask, and I haven't had a chance to see your earnings model on this one yet, but
it's actually in your report. If you
I don't know that I can get it right here, but I'll see it that way. But the only thing I would ask is, do you have a set of assumptions related to the deployment of cash and how that would get earnings? You talk about buying back stock, but then again, you have an assumption of how much they're going to buy back. What kind of return on equity do they have, and what would it be depending on how they deploy the cash? That's just a point of order. But I think your analysis and your presentation is excellent, and it's not for me to evaluate the conclusions. I'm trying to just get to the numbers, but that's the one line item that I would need to know to make a decision here, is exactly the impact of the deployment of cash. And remember, there was a 10% repatriation tax on the new tax bill. So the taxation of that is not nearly what it would be under normal circumstances. That's all I had. Excellent job.
Yeah, absolutely. I guess to answer that test question a little bit, honestly, we do have an election coming up this year, and it's been seen in Apple's past. I personally feel that they would wait till taxes favor them if they were going to bring back more taxes. Apple definitely has been very cautious with that and paying that taxes on that overseas money while they're bringing it back. Thank you, Mr. Gar.
Josh, I believe you had your hand raised as well. All right. I guess, Josh, that might have been a typo. Professor Hariharan, you have your hand raised. Go ahead.
Josh is back. I'll let him go.
Oh, okay.
So my question is, I know that Apple's getting into healthcare, and their new watch is very, like, one of their biggest aspects of it is that they track the blood and oxygen, and they're getting into health data. So I was just curious why you didn't bring that up in your report, because that could be important.
Yeah, absolutely. That is an important factor for sure. We focused more just on the overall company as a whole and how it's overvalued. We did talk about that segmentation and their innovation. That would definitely fall in line with things like that, how we mentioned AirPods and Apple Watches. But we didn't bring up that specific part. But yeah, that would fall in line with when we talked about the segmentation expansion and how that could provide more income in their future.
Especially now with everyone caring about their health, that could definitely be more growth.
Thanks.
Professor Harahan?
Yeah, just a quick point. I'm always confused when somebody recommends that we sell a certain fraction.
Yeah.
Why do you have 39%? Is there a justification for doing that as opposed to just going all out?
Yeah, that's a great question. We feel that Apple's the industry leader. One important statistic I feel I mentioned was that popularity among the younger generation. We feel Apple will overall win this kind of technology where we're seeing, and will be the most popular smartphone to use in the future. And it's because of that that we want to keep our position strong. Not to mention, with the way the market's been reacting lately, we definitely still want to be involved in the information technology sector leader. And we recommended a partial sale because our position size doubled over the last year. And so this partial sale will allow us to sort of scale back our position while also giving us an opportunity to still be exposed. I believe Mr. Harmon had a question. if that answered your question, Professor Arhan.
Yeah, I'm good. Hey, Troy, welcome.
Hey, thank you. I have two comments. Number one, I think you're focused in the right direction. The valuation of the company and overall, just let me tell you, I agree pretty much with your assessment because it's a world that I live in as well. We hold Apple at an underweight, and that really might be more what you need to focus on when asked a question like Professor Harharan asked you just now. It's kind of a straddle in as much as you want to be exposed, but you don't want to be market exposed. If you didn't have exposure to a fistful of companies, including Apple, over the last 6 months, you really would have gotten left behind. But at the same time, when the valuation is double its long-term average, you would really have to see something that drove the action. And I think the analysis, with the questions that you've been asked about healthcare and various other things, you really need to quantify how much that growth or potential growth might add to the bottom line at Apple. And I would imagine it's not going to be a whole lot.
Yeah, absolutely.
Good job. I appreciate it.
Thank you so much, Mr. Harmon. And yeah, just as you said, the bottom line, and as we mentioned, that product services, you have to think that 60% of the revenue came from the iPhone. So even the Apple Watch section as a whole, I believe, was just around 11%.
Yeah, and we have time for one more quick question from Zach.
Yeah, obviously, I just wanted to mention or just kind of question why, what you guys think the Fed, obviously the Fed's been buying bonds and will continue to buy bonds. Apple's one of the companies that they mentioned. How do you think that'll kind of play into how people see this company as a long-term value moving forward?
Yeah, that's a good. Oh, I'm not sure if Raul was answering that.
No, you go ahead.
Okay. It's kind of hard to see on this Zoom call when someone else is speaking or not. Sorry about that. Yeah, that's a great question. I truly feel Apple will always be one of the safer investments and obviously a huge blue chip stock. And the bonds, I feel that if anything just strengthens that argument, honestly. I don't think the company's going to go anywhere anytime soon. Thank you, Zach.
Thank you.
Of course.
Yep. Thank you for the presentation. That was great. I know there are a few tricky questions at the end, but we have to wrap it up now. So Disney, go ahead and screen share whenever you're ready.
Hello, can everyone hear me?
Yes.
All right, nice. All right, hi guys. My name's Harrison Keener. I'm a junior analyst. TJ, are you there?
I'm here. I had to take myself off mute. All right, my name is TJ Martin. I'm also a junior analyst.
And today we're going to be pitching a hold on the Walt Disney Company. So for the company overview, Disney is a diversified international family and entertainment media enterprise. Their business segments include media networks, parks, experiences, products, and direct-to-consumer streaming. They're well known for their ability to merge their creative brand with innovative technology. And currently, Disney's market cap is at $225 billion. And then right here in this pie chart, you can see a breakdown of their segment revenues. Most of Disney's revenues come from the media networks and the theme park segments, but their direct-to-consumer segment, which includes their streaming platforms, is growing rapidly. And this can be seen from just 2018 to 2019. The revenue from that segment grew from around $3 billion to $9 billion, which was before Disney Plus was even released. Next, TJ is going to be going over the investment opportunities and risks.
Okay, so as Harrison mentioned, Disney has many different business segments that has always deemed itself a great investment opportunity. In 2019, they recently acquired 20th Century Fox, which put them in a powerful position to stay on top of the media landscape. Following that, Disney Plus streaming service was rolled out, and in its first year, they have over 60 million subscribers, and it's expected to continue growing. And in addition to this, they also have majority ownership of Hulu that they acquired with 20th Century Fox and ESPN Plus streaming service. And ESPN Plus isn't doing as well as Disney Plus right now, but that's partly due to not all of its ESPN offerings being available on its ESPN Plus platform. But with the decline in cable television and the rise in streaming, we see that changing in the near future. Another thing to look out for is Disney just introduced its Star Wars theme park, and it's actually introducing another Marvel theme park once operations are able to go underway again. So we believe these are going to be high revenue generators for Disney in the future. Here's a chart that kind of shows the Disney versus Netflix subscriber comparison. You can see that in 1 year, Disney has 60 million subscribers. And this is kind of significant because this was their 5-year goal. So we believe that their growth potential is pretty limitless going forward. And then you can see that Netflix has 180 million subscribers currently, but they've been offering streaming services since 2007. While this does hold a great investment opportunity, it does have some risks that we have to take into account. COVID is likely to have a negative long-term impact on the movie theater industry. Obviously, with people not really wanting to go out and chance the possibility of catching COVID right now, it's easier to stay home, especially with the rise of streaming services too, when you can get new movies directly to your home theater. The movie theater industry is likely to decline going forward, and Disney has generated billions of dollars from the movie theater industry over the years. And as with movie theaters, consumers might be hesitant to enter crowded theme parks for even years. We don't really know what to expect, even with the vaccine, because while we are expecting a vaccine soon, there still is no guarantee. And then when there is a vaccine, we don't know how effective it's going to be. And then are people going to be rushing to get this vaccine right away? Another risk that we have to watch out for, direct-to-consumer streaming is on the rise, but with Disney's current cable packages, we don't necessarily know that it's going to be more profitable yet. Harrison is going to go over our industry overview and Disney's competitors.
For the industry overview and competitors, Disney is in the entertainment industry and has multiple different competitors depending on which segment you're looking at. Overall, the entertainment industry is mainly ran by a few large companies, and this gives them greater pricing power. Also, there are high barriers of entry into this industry as it is very expensive and costly to develop and promote new types of entertainment, whether it be movies, TV shows, cable networks, or theme parks. Another thing is to consider is the supplier power, and we believe there's little to no supplier power in this industry, as most of the companies are vertically integrated, as they own the rights to many different intellectual properties. They own production studios, and they own the media networks and streaming platforms that produce the final product. And then this industry also reaches a large amount of customers with limited substitutes. So the buyer also has little power in this industry. And then looking at the financials compared to other media network giants, Disney is trading at higher multiples, which may look like it's overvalued, but this is due to the recent success of all their streaming efforts. This has really boosted the outlook on the stock and the price. So we believe Disney might be a better comparison with Netflix. And compared to Netflix, Disney does look undervalued. And they also have we also believe they are better financially leveraged than Netflix or the rest of their competitors, as they have a lower debt to equity ratio. Next, TJ will be going further into the valuation and looking into the earnings model.
Okay, so based off of our earnings model, we assume that revenue and gross margin are expected to decrease by 10% in 2020. And this due to theme parks being shut down, which makes up majority of Disney's revenue, and likely to be shut down for the rest of the year. Assuming a vaccine is developed in the next few years, we expect a spike in EPS once Disney is operating at full capacity again, followed by a steady rate over the next few years as they start to recover for lost revenues. Revenue growth will reach 18% by 2025 due to the rapid Disney Plus growth and the expected success for their newly introduced theme parks. So to conclude, we do believe Disney has great earnings potential. Despite Disney's setback from COVID, they do still hold a strong balance sheet with $23 billion in cash and cash equivalents versus $16 billion in current liabilities. However, with earnings likely to be low for the rest of the year due to social distancing guidelines being in play and some of the unknowns that we mentioned earlier surrounding COVID, as well as we have an upcoming election, which could affect how Disney is able to operate its theme parks going forward. Right now, we conclude Disney stock is a hold for now. So with that being said, thank you guys for listening, and we'll open up the floor for questions.
Good job, guys. I'm going to ask a quick question, and then Professor Igar just raised his hand. So it seems like streaming is a big part of your thesis. Is there a reason you suggest holding Disney instead of selling this and maybe buying another company that's bigger into the streaming area?
Well, for now, I think there's potential for Disney's stock price to drop even more this year. Like we said, earnings are likely to be low for the rest of the year. So with the election coming up, that may actually affect the way how because Disney's theme parks are open right now, but they have social distancing guidelines in play. But depending on what party gets elected, that could change whether they get shut down again or say we have a resurgence in the virus soon. They could cause their stock price to drop even lower. So I think it is a buy in the future, but I think there's potential for the stock price to drop even lower.
Okay, Professor Gar, go ahead.
Hi, I think this is a great presentation. Personally, I kind of would prefer if you could put a piece of the earnings model up on the screen when you do these. I know we can get them another place, but anyway, you have an earnings model, so that's good enough for me. Here's the question that I had. You said on the one hand, if things turn out well, there's a spike in revenues. On the other hand, you said that in the movie business, people may not go for years. Maybe they will, maybe they won't. Leaving aside a subjective guess on a vaccine or whatever, because your guess is mine, do you have something in your earnings model for a base case or a best case? Maybe people don't go to the movies, or maybe this sucker turns on a dime. I don't know. But it would seem to me that there's at least some chance here that, remember, my job here is to do the numbers, that it seems to me that the numbers could really explode both on the revenue line and on the operating margin line. Again, like I said in the last presentation. So have you thought about that, a base case and a best case? Or maybe you've already done that. I haven't seen your model, but I think you want to be prepared with that, because we could all get whipsawed here, and this thing turns the right way, this stock is going to go to the moon. Or maybe, it's like zero sum. It could either be really great or really bad, but do you have a model in your numbers to show that if it turns, here's what we think they could do? That's my question.
Well, in our model, we actually do predict high growth, just not this year. So while we're saying hold, we're not saying hold for a long-term period, because long-term, we do believe this stock will blow up. But I think just holding until the election just kind of makes more sense, just so we can kind of evaluate going forward after that.
But I'm asking if you show it in the numbers. That's what I'm asking. I know you have an opinion on the stock price. I'm saying you have a base case of where the leverage is in the numbers. That's what I'm asking. If you don't, it's okay. But that would be my question in the real world. That's what I would ask you right here.
Okay, yeah, that would be something we need to take a look at.
All right, you did great.
Thank you.
Patrick, go ahead. And just one quick note, Professor Gar had a really good idea. If you could share your slides as we're doing the Q&A, that would be really helpful for everyone else going forward, so we can click back and forth when we're referencing something. But Patrick, go ahead.
Thank you. So during your Disney presentation, I noticed you talked about their theme parks a little bit. I don't know if you heard that they were going to overhaul the Epcot Center, but then they had to cease that Epcot overhaul. Do you think in the future they'll try to continue with that overhaul, and how do you think that's going to affect the company?
I'm sorry, what was your question again?
So Disney was going to overhaul their Epcot Center in like 2020, 2021, close to 2022. But since COVID hit, they had to stop that. Do you think and kind of cut their losses. Do you think they're going to try to continue their overhaul on Epcot? And do you think that's going to affect the company at all?
Well, I feel like that kind of depends on how things are going to go in the near future with how social distancing guidelines go. So if people start coming back to the park and revenues are promising there, then yeah, I feel like they will keep going ahead and with overhauling Epcot.
Okay, thank you.
All right, and we have time for one more question. Steven, I see your hand raised, but I think Troy beat you to it. So Troy, please go ahead.
Hey guys, the only thing that I would say, especially at a time like this, is I would have liked to hear more about the liquidity situation at Disney, especially with operations being so hampered by the COVID shutdown. And of course, none of us know when that might go away. And I think what you really need to see is how much cash they have on hand to bridge the gap through this tough time for them. I think it would have been good for you to talk a little more about that, and it probably is the reason that to Patrick's point, probably the reason that Disney stopped a lot of their expansion. There are loads of companies that have cut back on capital expenditures right now, and even some have cut dividends. So cash is king, and cash has to be protected in a spot like this. So while I think Disney's going to be okay, I agree with you guys to an extent that earnings will come back. The other thing is, if you look at valuation, current valuations are, the price to earnings is about 50, which is way above where the long-term average is on this company. So I think some of that rebound is already expected by the market. And while earnings could explode, I'm not so sure that stock prices will. But good analysis. I enjoyed the presentation. Just, a couple of things for you guys to look out for going forward.
Thank you.
Thanks.
And with that, Cerner, please go ahead and share your screen whenever you're ready.
Can everyone see that?
Yes.
Okay.
Hi, everyone. My name is Sahal Sugar. I'm a senior analyst.
And my name's Cole Everett, and I'm a junior analyst.
And with our current holdings on the Cerner Corporation, we're pitching a hold. Cerner is one of the leading providers in the healthcare IT industry. It provides hardware, medical devices, and software. However, its specialty is the electrical and medical recording systems for hospitals and clinics. It provides 3 different main softwares, which are Cerner Millennium, Healthy Attend, and Careware. The first 2 focuses on the operations of the hospital, so it helps with the operations, whereas the last one focuses on the medical devices and patient tracking. All these services combined help Cerner earn $5.6 billion in revenue in 2019, mainly driven by the professional services and managed services. So these are the systems they're selling to the hospitals and running it from the data warehouses. And most of this revenue came here in the US. So these are recent news that are important, that we think is important to the earnings model and will affect it in the future. Cerner just announced a deal with Amazon. They're releasing a new fitness tracker called Amazon Halo. It's supposed to be more advanced than the ones on the market right now. It's supposed to allow 3D mapping of your body. Cerner also announced another deal with Vinca Health, which is another IT provider for advanced care planning. It's supposedly allowing more seamless connections with their systems in that sector. And Cerner announced their new chief strategy officer named William Mintz. He's known to be more product innovation driven. So we expect more R&D expenditure in the future. Lastly, Cerner is just now it's starting to capitalize off their veteran affairs deal that they made back in 2017. Strengths of Cerner are its large market share of 25% and more. The main reason why it has this large market share is the services that it provides are hard to duplicate. So it's hard for a new company to come in and make that because of the capital expenditures. And since it's been doing this for a long time, it has established federal contracts and client connections. Some of the weaknesses for Cerner are higher operating costs. Even though external competition at the moment is a little low, internal competition in the industry is high. So it has to expend a lot in R&D to optimize the software to get more of those federal contracts. Also, their revenue is mainly from the US, meaning it's not that globally renowned. Some of the opportunities going forward are winning more of those Department of Defense contracts and Veteran Affairs contracts and more partnerships that can put Cerner into different markets. Currently, the demand for system services like the ones that Cerner provides is high because of COVID. A lot of hospitals want patient tracking services. And some of the threats are Microsoft and Apple. They're looking to get in this industry more. Recently, Microsoft announced a partnership with Allscripts to get more into this industry. And if Cerner were to get hacked, that could really damage their reputation and hurt their revenue models.
So as we shift to an industry overview, some things to note are high barriers of entry. The industry's revenue is expected to grow by 3% annually from 2020 to 2025. And we'll take a look further at this in the next slide in our earnings model and apply it to Cerner. Some industry drivers are product reliability and accuracy, as well as government contracts. And as we take a look at the numbers here, one thing that stands out is Cerner's debt to equity ratio compared to its competitors of 0.33%. This means Cerner is able to handle its debt better and is better leveraged. Now we take a look at price to sales and price to earnings, and it is higher than its competitors. However, this is due to the fact that Cerner is a much bigger company than these competitors. So as we take a look at our earnings model, some things to point out are the high EPS year-over-year growth in 2017 of 39.17%. This is due to the rollover of a Department of Defense contract, followed by 2018, where we saw a huge decrease in EPS. However, this is due to, like we said, in 2017, the big spike in revenue. Some other things to point out are the aggressive share buyback policy of the company. The company recently committed to buying back $12.9 billion in stocks. So these are our discounted cash flow models. Some things to point out are, for the base case, we used a 5.44 required return, which is the weighted average cost of capital. And this gave us a fair value of $62.87. However, Cerner is currently trading above this at around $72 per share today. We believe that DCFs aren't the best way to evaluate IT companies due to their high research and development expenses. With the bear case, we upped the required return to 6.5% and got a fair value of around 45.98. But like we said, we don't believe DCFs are a fair evaluation of IT companies, as well as we don't believe 6.5 is feasible for Cerner due to the fact that it's a slow growth stock. So in conclusion, we do recommend holding the 60 shares that the firm currently holds at around $4,300 in value. Like we said, this is due to the fact that it is a slow growth stock. With a beta of around 0.8, it is not going to move as much as the broad market, so that it makes it a little safer investment. And although it does have high operating costs, we believe that it is the best positioned of the industry to reach new clients through government contracts and partnerships. So with that, are there any questions?
Professor Gar, please go ahead. And then after that, David has a question. And then we're running a little bit behind, so those will be the only two for this.
I'll go quick. This was a great presentation. And the reason it was great is you made 3 or 4 assumptions, and every one of them you brought it right back to the earnings model and showed how to reflect it. One thing that I went through this with Vinny Rosamillo all the time last year is, since you brought up debt to equity, that opens the door to ask the question about return on equity. And I would submit that since debt to equity is lower, and you mentioned it's a slow growth company, it's probably what they would call under leveraged. If this was a buy, I would want you to give me a return on equity versus the other companies in the industry, because it's why it's probably growing slower. It's because they probably could leverage, they could be more leveraged. So it sounds like a counterintuitive argument, but that's the way it works. So I think your presentation was outstanding because I thought you brought it all back to the numbers. That's it. That's all I got to say.
Thank you, Professor.
Yeah, so you talked about how it grows kind of slow, but for your DCF, your terminal growth rate, how did you decide on that?
The terminal growth rate?
Yeah, the perpetual growth, the 2.5%.
So that perpetual growth rate is just a a base reference, and it's generally agreed upon at around 2.5%. Sahal, do you want to talk about that a little bit?
Yeah, so we kind of focus on how the risk is right now, and as interest rates are low, so we think it's going to be low going forward. We kind of base it off of that.
Oh, okay.
All right, those questions were shorter than I thought they would be, so I'll throw in the one last one. So your valuation says it's roughly overvalued, I believe, on both of them. So why not pitch a sell?
Yeah, so like we said, we don't believe DCFs are the best way to evaluate a company like this. Since IT companies have greater research and development expenses, it kind of ties up some of that free cash flow. So the free cash flow isn't necessarily reflective of the value of the company, at least for an IT company.
All right. I get what you're saying. Maybe look into it a little bit more because that should be accounted for. But that's all the time we have for this. Thank you for the presentation. I know those were another set of tricky questions at the end. I believe Home Depot is next, so please go ahead and share your screen and start whenever you're ready.
All right, let's see. Everyone see that?
Yeah, it's there.
All right. Well, my name is Luke Almer. I'm a senior analyst.
I'm Chandler Geiger. I'm a junior analyst.
And we're pitching a buy for Home Depot.
All right. So the Home Depot has performed well throughout the entirety of its pretty much existence. Right now, it has more than half of the home improvement market share. And as smaller companies are leaving the market, Home Depot continues to thrive. Home Depot's demographics are younger than Lowe's, indicating potentially more long-term growth. We can move to the next slide. The Home Depot is a fairly safe company and follows the market well with a beta that has been consistently close to 1 and a fairly unlevered quantity of debt. This year, the Home Depot has paid off debt as well as buying treasury securities and recently has been increasing dividend significantly, signaling an abundance of free cash flow. With more time spent at home and less time with groups, we expect Home Depot to be in a very strong position looking forward as home improvement becomes a more common hobby. Low interest rates are encouraging for home buyers, and a higher number of home sales has historically correlated with Home Depot revenue. Since Home Depot focuses more on professional customers than Lowe's does, these future housing starts will help Home Depot increase sales quicker than Lowe's. Now Luke will talk about industry and competition.
The home improvement industry is made up of businesses that purchase goods from manufacturers and resell the products to do-it-yourself consumers and contractors. Stores in this industry focus their attention towards home improvement and maintenance. The home improvement market is heavily weighted to a few competitors. Home Depot, Lowe's, and Menards make up the majority of the market. The percent of market owned by smaller companies is dropping year over year. The strategy of home improvement executives has been to start shifting towards technology, both in products sold and in infrastructure. Looking at the market share and competition, Home Depot currently holds 52% of total market share in the home improvement industry. As smaller competition in this industry are losing their market share, Home Depot is gaining market share, and Lowe's, which is their main competitor, is just trying to keep up. In the past few years, Lowe's has been bringing in significantly less revenue than Home Depot, and they too lack in growth rates. We do not believe that Lowe's will be able to expand to the same level and pose a threat to Home Depot anytime soon. Home Depot will continue to dominate the home improvement industry. Looking at some key some external drivers, the home improvement industry is propelled by strong, high-performing key external drivers. From 2020 to 2025, urbanization is expected to grow in the U.S. with a projected 1.63% annual rate. This will increase the number of households. And with lower interest rates, disposable income and private spending on home improvements is also expected to increase. With housing starts expecting to increase, the demand for contractors and contractor equipment will increase, which also supports the home improvement industry. With all of these key trends in mind, it is clear that the demand for home improvement services will continue to grow. Now we're going to look at
Home Depot.
Sorry.
Home Depot recorded record sales this last quarter, a 35% increase from second quarter 2020 sales, and this is also a 23% increase from this quarter last year. Certainly, the stimulus money has encouraged the spending, but regardless, it would be shocking if the Home Depot's earnings is not greater than 8%. Is not greater than 8% this year, and I would not even be surprised if we see a 10 or 11% increase from last year. The revenue in 2021 is less certain, as metrics that affect the market as a whole, such as unemployment, haven't been particularly the best. But given Home Depot's beta is similar with the market beta, and much of the spending in 2020 was due to the stimulus, we caution that Home Depot's sales could be less spectacular in 2021. However, in the long term and medium term, we expect very good and very consistent growth. In moderate markets, at least 5% earnings growth is very likely, and in bull markets, growth could be above 7%. An important note, we did a sensitivity analysis for the earnings model, and here's why. In the years fiscal 2017 and 2018, the federal tax rate that Home Depot paid was drastically cut, which has served the company well, increasing overall earnings by in between 1.5 and $2 billion every single year, which increased profit margin by about 2%, I believe. Their effective tax rate went down from 36.4% to 23.5%. And because of this, I did a sensitivity analysis, assuming the tax was reversed by new politicians. And this is a very significant detail, and which would obviously affect the company's valuation. And if we knew for certain that the tax for Home Depot would be reversed in, let's say, 2021, our pitch would probably be a little bit different. But this is basically our growth analysis, and we expect somewhere in the range of 6 to 7% consistently year over year.
In conclusion, the Home Depot has been a valuable asset in our portfolio, and it will continue to be one. As revenue and market share climb, Home Depot will continue to dominate the home improvement industry, and with healthy financials and steady growth rates, Home Depot will be a good buy that will offer a secure return on investment. Are there any questions?
Yeah, I guess I have one quick question. I think everything I saw was great. I did a little back of the envelope when you had your earnings model up there, and you have a constant 34% gross margin every year. Home Depot's been trying to get into, online sales and all that. Gross margin is usually a good indicator of pricing. Do you feel pretty comfortable that the gross margin will be constant, or do you think it'll go up or go down?
We think it's going to continue to go up because we were reading into that. They were in their 10K. They're definitely talking a lot about how they're investing a lot more into e-commerce, and they're putting a lot more into technology, trying to reach customers in a different way rather than being a traditional brick and mortar kind of fashion. Chandler, do you have anything to add to that?
But in the model, you have a flat gross margin percentage. Remember, gross margin is a percentage, so it's right at 33.9, 34%. So you believe that the number will go up absolutely because revenue will grow, but the percentage number you have constant. Are you pretty comfortable with that?
Yeah, we do see pretty. Sorry, trying to go.
Yeah, me personally, Home Depot has been really, really consistent year over year for like several years. I could foresee in the future the gross margin percent increasing, but I think that would be a little bit longer term than the next few years.
Okay, that's fine. Good job.
Thank you. Are there any other questions?
Well, it doesn't look like anybody else has anything else to ask. So, good job. I think Church and Dwight is next. So feel free to start whenever you're ready. Oh, I'm sorry. Steven had a last minute question, I believe. Steven, try to make it quick. We're a little behind.
No, you're good. We can skip it.
All right.
All right,
Can
Church and Dwight, go
everyone-
ahead whenever you're ready.
Yeah, can everyone, let me see my screen okay? Are you seeing my screen?
Yes.
Yes.
Okay. So my name is Camille Suarez. I'm a junior analyst.
Hey everyone, I'm William Loftus. I'm a junior analyst.
Afternoon, everybody. My name is Drake Register. I'm also a junior analyst.
And together we did Church and Dwight for current holdings. All right, so Church and Dwight primarily focuses on household products, which account for 51% of revenue, and personal care, which account for 41%. Their gig sector is consumer staples, and their subsector is household products. They are primarily driven by 12 power brands, which account for 80% of their revenue. And the most important one is Arm & Hammer, which brings in around $1 billion in revenue annually. Church & Dwight is also the largest producer of baking soda globally, with baking soda being around 15% of their sales. The growth strategy is primarily focused in acquisitions. Their power brands were acquired in 2001 and earlier, and their newer acquisitions include Waterpik, which is a water flosser, which is their biggest acquisition yet. They acquired it for $1 billion, and Flawless, which is a women's shaving company. And we can see the company moving from these general brands to more unique niche, small niche brands, which can kind of hurt the company in the future. Church & Dwight just reached their 52-week high at $98 last month, September 2nd. And since then, their price has been decreasing to $93 closing.
Yeah, I'm going to talk about the industry and some competitors. So home products and personal care is a broad and highly competitive sector, with it generally being broken down into 3 subcategories: household products, personal care products, and specialty chemical items. Household products include laundry detergents, fabric softeners, carpet care items. Personal care products that Church & Dwight offer include deodorants, multivitamins, toothbrushes, toothpaste, condoms, etc. And then specialty chemical items obviously include baking soda, a staple of their brand Arm & Hammer, and other chemical products in a plethora of uses around the home. The sector is obviously broad, and that's kind of a disadvantage for Church & Dwight as they're competing with some of the powerhouses of domestic production, such as Procter & Gamble, Clorox, and Unilever. Procter & Gamble in particular is a huge competitor. In just the second quarter of 2020, their net sales were $17.2 billion, with an operating cash flow of $1.7 billion in the same time. And the competition in the sector has gone through changes with the COVID pandemic. They've been leading towards a jump in e-commerce, not Church & Dwight in particular, but other companies in the sector, such as Procter & Gamble, have been partnering with Amazon. Procter & Gamble is now sharing warehouse space and pushing their items more towards online sales in Amazon. and that has shown a 30% e-commerce growth sale from the 2019 to the 2020 fiscal year. Church & Dwight in the same amount of time has only increased around 1% in total e-commerce sales. So with big players in their field, such as Procter & Gamble and other smaller brands that sell directly to retail stores such as Smartly, which is a personal care product sold at Target, the sector for home products and personal care is an increasingly tough place to continue successful because it's so saturated. Next slide, please.
Hey everyone, so to bounce off what Drake said, Church & Dwight are currently competing for market share among some of the titans of the industry, such as Procter & Gamble, Clorox, Unilever, Johnson & Johnson, and Pfizer. Almost all their competitors within the market have the capability to just sheerly outspend Church & Dwight. An example is so far in 2020, Procter & Gamble has netted $71 billion in sales compared to relatively meek $4.1 billion by Church & Dwight. Their larger financial backing of their sector adversaries allows them to respond both more rapidly and more appropriately to ever-changing business and economic conditions than Church & Dwight. Their industry is overall highly innovation-driven, which is notable through a continuous stream of both new products and product line extensions. With Church & Dwight focusing more on acquisition rather than innovation, they tend to run the risk of falling behind the market. Church & Dwight struggles with product diversification compared to their competitors, with only 3 main product segments producing general revenue. They also struggle diversifying domestic and global sales, as only 8% of their sales overall come from international markets. Basically, they're financially outgunned by their competitors. Contending companies are able to research and develop, innovate, and release new products into the market much faster and on a much widespread scale. Next slide, please. So our recommendation is, based upon our analysis, we believe that our best course of action is to liquidate our position with Church & Dwight. Overall, they struggle to compete within their own market. They struggle to consistently increase their net sales. Their lack of overall innovation and diversification hurts them. Again, they're being financially outgunned by their competitors, who are basically eclipsing Church & Dwight in both innovation, diversification, and product marketing.
All right, so here on our earnings model, we can see how Church & Dwight has been growing at a decreasing rate. So we can see in 2018, they had 10% growth, and that slashed in half to 2019 with only 5% growth. And surprisingly, they actually spiked in growth the second quarter of 2020 with 10.7% growth, which has led us to estimate a 9% growth in 2020. However, we think that there's a lack of products and the product line is too concentrated. So we see that the growth rate is going to return to pre-pandemic levels, that being 5% and continue to decline. And we can also see that as how they struggle to adjust to e-commerce sales. We also projected an increase with the cost of sales because of cost with transportation, increasing costs with sanitation, and just supply chain slowdowns. And we can also see the decreasing dividends from 2016 to 2019 and decreasing earnings per share from 2017 to 2019. And that just supports our position to liquidate our shares with Church & Dwight. And that's all for our presentation. Anyone has any questions?
Rachel has a question.
Yeah, hi guys. I just purely based on how many times Procter & Gamble was mentioned during the presentation, I'm just curious as to why you guys didn't kind of pitch a swap instead of just a complete sell.
Well,
I didn't even know that was an option to be able to be done. So that's.
But I think a swap would be a good idea. We've seen, as I think Drake stated, there has been a 30% growth in e-commerce sales with Procter & Gamble. So I would definitely look into Procter & Gamble and their metrics, their income statement, and maybe we could discuss a swap in the future.
Okay, thanks, guys.
Yeah, thank you.
Thank you, guys.
All right, it doesn't look like there are any other. Oh, Professor Hariharan has one question. Please go ahead.
Professor Ron, you have a question?
Yeah, Professor, I think you're muted.
Yes, I am. My apologies. Just a quick point on the swap issue. We don't want to consider them together because of the fact that then we have to research another company at the same time with the same level of diligence. So what you might consider is in the equity round, think of Procter and Gamble.
Yeah, definitely. Thank you, Professor.
Thank you so much.
All right, it doesn't look like there are any more raised hands. So good job. And Delta, please
All right,
start
thank
whenever.
you so much.
Oh, excuse me, what was that? Oh. Well, Delta, please start whenever you're ready.
All right. Tyler, you can go ahead.
Hello, everyone. I'm Tyler Sedith. I'm a junior analyst.
I'm Noah Abert. I'm a junior analyst.
And we are pitching a hold on Delta Airlines. Delta has been a big name in the airline industry for a very long time now and has stayed consistent with the market, as you can see from our graph. But due to recent events, Delta has experienced loss and underperformed due to this pandemic. In this chart to our right here is a breakdown of the revenue. It is split into two segments, an airline segment, which is made up of majority of ticket sales and is 90% of their revenue, and a refinery segment, which is the other 10% of the revenue, consists of producing gas, jet fuel, and oil for consumption. And these numbers below the chart are their 6 months endings in June. For current events, now for the June 2020 quarter, capacity was down 85% in planes, and Delta's revenue was also down 88%. Business from home. Companies are now having to adjust to this pandemic, so they are working remotely and conducting online and virtual meetings, which in turn means less travel and less sales for Delta, since 26.4% of all business travel was done through Delta in 2019. And this flexibility to plan and rebook flights through September 2022 is something Delta has adopted to try and keep and retain customers from venturing out to seek other airlines. In this graph to our right here is a comparison between revenues from the two segments. And as you can see, 2020 is down significantly.
All right, I'm going to talk about the competitors and some of the key metrics. So I'm going to start with this RASM here, which is the revenue per average seat mile. And so what this is a metric that is used by airlines that measures the total operating revenue that an airline generates per empty seat or full seat per mile flown. It's measured in cents. Airlines like to use this metric to better explain their financial performance because it includes all additional sources of revenue, such as baggage fees, reservation change fees, and in-flight meals. So moving over to beta, the beta of all Delta and their competitors are above 1. The airline industry is slightly more volatile than the market, but out of its competitors, Delta and Southwest are most closely following the market. We did consider pitching a swap to Southwest, but after looking at their 10K, we noticed that there was a deficit in their shareholders' equity, so which could possibly mean something that we didn't quite look into that might not be good, so we sort of steered clear of that. So moving over to return on assets, while these are low return on asset values, Delta is one of the only ones out of its competitors to have a positive ROA value. This means that even though through these difficult times, Delta is rising above the pack. All right, so now I'll talk about the Porter's 5. So starting with new entrants, there's a very low threat of these because of the amount of capital and regulations that must be met in order to start an airline. So for substitutes, there's a relatively high threat because of the many airlines that offer a given flight. And this leads to an equally high level of competitive rivalry between the airlines through small price fluctuations as customers bargain hunt for the best deal. Suppliers have a low level of bargaining power due to seasonal price expectations, as well as the high amount of competition. And consumers also have a low level of bargaining power. They almost have no power in driving the ticket prices down because of the high demand for travel during normal times. All right, so for the valuation, we did a comparable companies analysis. According to the calculations, Delta should be worth around $34.35 per share, and it's currently trading around $31.06. Seeing that it's undervalued and outperforming its competitors by a large margin in every category, we think that it would be best to hold and take advantage of the high potential for future growth.
This industry shows promise for a possible large recovery due to, or an example would be Delta in 2019 showed a 6.5% revenue growth from 2018. And then even with these losses, Delta is still outperforming their competitors significantly. And then we recommend hold all current shares of Delta to this high potential of growth. Thank you. Is there any questions?
So I'll kick it off real quick. So I agree with the general thesis that airlines will pick up, but what about Delta makes you think that they can weather the storm until that time comes?
Really, because they're still very much outperforming their competitors. Like if you go back to the valuation.
Yeah, I guess what I was asking was more from like a financial strength point of view, if that makes sense.
Noah, you want to pitch in?
I'll try my best to think here. If I'm being honest, I don't really have an entire argument for that question.
Let me ask Luis's question another way. There might be another way to look at it.
Yeah, please go ahead.
Look at the amount of cash that they have. Look at the amount of cash burn that they have in a given month or quarter in terms of what they're spending, and try to project if they don't have a significant improvement in revenues, can they cover all their expenses or do they have to continue to borrow? I think that's where Luis is going. He's trying to figure out if they can have enough liquidity to survive. Mr. Harmon asked a similar question on one of the earlier presentations. I think that's where, Luis, is that what you were trying to get at?
Yeah, that's exactly where I was trying to get at.
Okay, thank you.
And Troy, I believe you have your hand raised. Please go ahead.
Yeah, I just kind of adding to that point, some of the things that you will want to look at, quick ratio, current ratio, as Professor Gar said, cash burn, but you can also use the cash ratio. It's just basically looking at, their current assets versus their current liabilities and seeing if you believe that they're going to be able to weather the storm that they're in. This thing, I think, airlines are probably going to be some of the last companies that are going to be able to get back to normalcy, and part of it can be seen when you look at recent travel traffic. When you look at how many planes are flying and how few people are on them, so their costs are actually higher than their revenues, even though they do have more planes flying. It's on par with maybe 30% of normal that they have as far as planes moving, but maybe 10% relative to passengers. So this is a really difficult thing to see, and I think it would take a lot of convincing to get me on board with a Delta Airlines investment.
Okay, thank you for that insight.
Yes, and then Zach, wrap it up. But before that, I want to say we have one more presentation left, but I do know that some members have 8 p.m. classes. So if that is the case, you're welcome to go. Just let your MDs know. And Zach, please wrap it up for us.
Yeah, absolutely. Great presentation. I just wanted to say I've been through the recent flying experience, and it is way different than what it's typically like. There's still empty seats in the middle rows. So there's obviously a lot of lost revenue there. Things are a little different when it comes to operating costs because there's been a change in how they divvy out alcohol and a variety of things, right? So what do you guys think is what's the driver behind the high potential for future growth?
So I think that after all of these travel bans sort of are lifted and the consumer confidence starts to grow again after we get a vaccine and after just after a short period of time, I think that people are going to be eager to resume those travel habits that they previously had, even though we may be losing some of those profits in other categories.
Okay, thank you.
Thank you.
So it doesn't look like anybody else has any questions. So let's move on to CVS. Great job. I know Delta is one of the trickier ones to analyze the future of, but you did a great job looking at it. So CVS, please start whenever you're ready. And like I said, if you have an 8 p.m. class and you need to go, you're more than welcome to leave.
Can y'all see that all right?
Yes.
All right, so my name is Christian Bennett. I'm a senior analyst.
My name is Trevor Hassel, and I'm a junior analyst.
And we are pitching a sell of CVS Health Corporation.
As many or most of you know, CVS is a large retail healthcare provider, which means that their specialty is on the sale of prescription drugs. And then along the side, we have their overall retail sales that you see, such as shampoo, toilet paper, you name it. This means that they're heavily reliant on the sale of these prescription drugs. That comes very apparent in their overall cost, with their cost of goods sold being upwards of 86%, which is a very high number. Over the past 5 years, we've seen about a 50% decrease in the overall value of CVS in comparison to the S&P 500, which is at times flirted with it rising at 70%. And as we go along, we'll see that the overall industry for retail healthcare providers reflects this as well. CVS has been trying to mitigate their loss of revenues along with their valuation through their attempts to expand their services outside of retail. And we see that in their two acquisitions, one very recent. The first being Aetna in November of 2018, which is a health insurance provider. And then Minute Clinic, which used to be a long-term competitor. And these two together have been used to try to launch sort of their telehealth services. At the moment, there's really only about two direct competitors to CVS, and that being Rite Aid and Walgreens. And as you can see on the right, the industry as a whole has been suffering over the past 5 years, with Walgreens and CVS being about neck and neck in terms of some of their losses, around 50%, and then with Rite Aid almost bottoming out at minus 100. One thing to note about this is that it seems that none of these companies have really been able to take advantage of the COVID-19 pandemic. During a worldwide health crisis, having these health providers not succeeding, I believe, speaks volumes to where the industry is at. And a more recent phenomenon is the emergence of certain companies or types of companies into the market. First being large grocers have been doing that. Walmart and Publix, and we'll get to see later of how they're in an advantageous state. And then the emergence of telehealth services, services where you can order your drugs from home. Just some key metrics to look at here is that CVS has a much higher debt rate than their competitors and the average in the industry, with being over a 1 value in their debt to equity ratio, and also that their inventory turnover seems to be lower in both aspects too, meaning that they're just not moving as much product as they normally do. The poorest five forces for this industry is a little bit lopsided just due to the unique nature of the industry with government regulations, with a threat of substitute and the bargaining power of consumers tend to be very low just because of regulation. Government regulation removes a lot of the variability within their product. And then the overall importance of medication for certain people and how that most people can't really forego a lot of medication makes it so they don't have a lot of bargaining power in terms of the purchasing decisions. Where things get to be more difficult for this industry has been the bargaining power of suppliers, where a lot of these regulations that have been out there, I believe in 2018 alone, the overall prices for prescription drugs went down about 17%. So a culmination of those things have shown a decrease in revenues. Threat of new entrants and competitive rivalry tend to go hand in hand just because a lot of the new entrants that are coming in are the ones that are driving the overall competitiveness of the market. Although it is difficult for emerging chains, we see that as before, grocers and telehealth have made it very competitive and caused major concern for CVS. PillPack coming onto the scene has really begun to kind of change things a little bit in the sense that people are at home now and they're able to order a lot of their drugs remotely. They don't have to go in for these services. And that's something that CVS has generally been lacking behind in terms of that, along with many others in the industry.
So when looking into their financial statements of CVS, we kind of got to notice the just how like their lack of consistent growth in their revenues, like overall percentage wise, and also their large amounts of debt that they've currently taken on through the acquisition of Aetna in 2018. The purchase they took on that was $70 billion. Along with that, they agreed to take on the $8 million of debt that Aetna currently had as well. Not only is CVS struggling due to their amount of debt that they have, but the whole industry as a whole is struggling. So as I looked through everything we saw, we kind of didn't really realize that, or we didn't really believe that they were going to be able to continue growing at the pace that they were within this time due to their debt, due to the industry dying, due to the new entrants of like PillPack, and people just kind of come up with new innovative ways to find new forms of revenue. So on the left, we have our forecasted revenue trend line from 2017 to 2024. The big jump in revenue from 2018 to 2019 was from the revenues they got from Aetna. So it did make a big difference for them. But however, we noticed from 2019 to 2020, there was barely any growth within their revenue segment, even with that acquisition. So yes, it did increase overall it increased. But we did not see a continuous growth. Yes, it is only 1 year, but we also know they took on large amounts of debt just to acquire that. So we do believe with COVID-19 playing a factor in just overall revenues as well, that we don't see a real upside in their revenues and being able to continually increase over a long period of time. By 2024, 2025, they did state that they were hopefully going to be able to have that debt kind of under control. So that's why we did use that a little bit of an increase there from 2023 to 2024 in their revenues. But we don't necessarily 100% believe that it is feasible, just to their lack of increase in revenue and their lack of ability to pay for that debt. We also have, as you can see, the debt increase on the right side, the long-term debt. We've also noticed in their 10Ks that they overall within the past, I believe it was 3 years, they have at least $11 million in interest expense alone. And that's only going to continue to increase as time goes on off of this acquisition that they have. Go to the next slide.
Overall, this industry is struggling. We've seen a lot of the dips in valuations for certain companies, decreasing revenues, and in the case of CVS, rising debt. And this is not going to get any better as we have new entrants moving into this market, such as telehealth, that have been able to provide services that CVS has been sluggish to add on to their overall business model. Right now, it's projected only about 24% of their revenues have been attributed to that sector in there. And overall, with just the revenue decreasing, or we expect it to decrease over time, the substantial debt that they've accumulated, we don't believe will be reeled in for the foreseeable future.
So the current weight in our portfolio is only 0.97%. We are proposing a full sell of all 46 shares of CVS. We already are at a negative 9.48% return on this company. If we sold now, we would probably get back, I think, around $2,000. So we think that it would just be a lot better avenue for us as a firm to reinvest that into something else that's probably a little bit more lucrative. And thank you guys for your time. Any questions?
Oh, thank you. So like I said, this was the last presentation, so I'll give a few extra minutes for questions if there are any. But Professor Hariharan, I saw your hand first, and then Professor Gar, please go ahead after that.
I'm kind of puzzled a little bit because I recall, I believe it was a year ago, just prior to the merger of CVS and Aetna, we had both, and we decided to sell off our stake in Aetna and kind of capture some of those gains. One of the plus points in that is the fact that it was a vertical merger, right? So one thing that Aetna has been trying to do is try to push more of the enrollees into buying pharmaceutical products, etc., from CVS, using CVS services. Whereas most of your attention has been on pharmacy, I wonder if you ever looked at the vertical nature of it.
So we looked into like how much revenue they actually got from Aetna and Minute Clinic, and we pretty much it was a 24% increase of revenues just through those two acquisitions. So yes, it definitely gave them that increase, but overall, their still majority of their revenue was coming through pharmaceuticals. That's kind of why we were more focused on that area.
Okay. Thank you.
And I guess it's to me. I guess I have a couple of things. I have a list of things, but I'll go quick. I think a couple of the things, I think you're probably right about selling the stock, but some of your logic is good and some of it didn't grab me too much. You talked about cost of goods sold being 86%. This industry, everybody's got big cost of goods sold because what are you? It's a bunch of stuff on the shelves. You also said that it's going to be hard to get the debt under control. It's hard to get revenues under control because of their debt. I'm not sure I understand how that would happen. Now, you mentioned that their inventory turnover is lower than Walgreens. I think you may be right about that, but I'd be kind of interested in why that is. But the big one that pulls all that together to me is this seems to me a story of traffic. What is it that gets people in the stores? And they sell a lot of things in these stores. And if they're not coming in to buy prescription drugs, okay, I see your point. Then they're not buying shampoo and toothpaste. But whenever I get a flu shot, I get it at a CVS store. And there's a whole bunch of other things. And what happens if CVS stores suddenly get COVID vaccinations that they can give? You can go to your local CVS and get vaccinated for COVID. I mean, the traffic in the stores is going to be 180 degrees the other way. People will be all over the place. And it's very possible that happens. So, I mean, I don't know, maybe I'm wrong. I could be wrong. But what do you think about that?
That's a really, really, really good. Honestly, I didn't even think about that. Honestly, I should have. That's a really good point. You want to jump in? I heard you about to talk, Trevor. Go ahead.
Yeah, I believe that's where a lot of these large grocers have where they've been coming in might be a major concern for CVS, because a lot of these customers they already have a lot of exposure while going into these stores like Walmart and whatnot. And Walmart, of course, already has a lot of pre-existing clientele, and that may be a lot easier to pull them in because people right now, a lot of them may be searching for convenience, and they don't want to go place to place, especially during COVID. So we may see more people go to a lot of these stores or pharmacies that may open up within these stores.
That's not what I said. That's not what my question was. My question is when you're old as Methuselah, like I am, okay, and when you go to get these shots, the drugstores can give you the shot. I get a flu shot by a pharmacist in a CVS store. What happens if they distribute this stuff out to the CVS stores where the CVS pharmacists are administering COVID shots? That's a real possibility. What will that do to the traffic coming in these stores if people are lining up overnight for when the store opens to buy or to get their COVID shot? If they are administering that, I mean, there's a pneumonia shot that I just got at a CVS store. There's a whole host of them that the pharmacists can do. I'm not talking about whether people will go to the stores. I'm talking about whether COVID shots bring them in.
I think really the main thing on that for me would be more so like, I guess for me personally, my level of consumer confidence in going to like a CVS for a vaccine or something like that, I would rather go to a doctor's office. I also think if there's that much traffic going into a CVS minute clinic for that, I don't know if they'll even be able to handle that level of people going in there all at once for this, because I do feel like that could be a potential thing where people are either chomping at the bit to get one, but then I know other people also have different views on vaccines. But overall, I think if Kroger was able to have something like that, or Publix or anything like that, I think that's what Trevor was kind of trying to say, is that like when you already have those major clientele that are loyal to going to that area and it's very in one place, let's say if Kroger had something where they had that vaccine, they had that thing, I think they would choose that over CVS. But you do make a good point, because if CVS can handle that level of traffic and be able to use that to a good point, that I definitely think that that's something we should definitely thought of and put into this.
Yeah, it's not the minute clinics; it's the pharmacists themselves that do it.
So okay, I didn't know. I've never gotten one from CVS.
Well, I didn't know you could do it until I got one, and then I knew.
I didn't know that. That's a good point. So we'll definitely need to look into that.
And Troy, I believe you have your hand raised. Please go ahead.
Yeah, couple of things. Number one, you guys didn't talk a whole lot about the strategy behind the fact that CVS merged or bought Aetna. Part of the drivers in this specific arena are not just demand from whatever marketing that they do. They make deals behind the scenes as distributors for drugs that, part of it is a partnership with the insurers. So when you've got a health insurance company that gives you the nod as their, one of their preferred vendors, it makes a huge difference. And I think that would be something that's worth looking into for you guys. When you concern yourself about debt, I look at the numbers and they don't really look that bad to me, especially when I see interest coverage almost 5 times, 4.76 times. So it looks like the debt issue is not really so bad. And oh, by the way, a little more debt actually brings down the cost of capital, which can benefit your valuation when you're looking into things like that. I just really think that some of your points are valid. I think we get a little too caught up, and by we, I mean all of financial markets, when we start worrying that technology is going to put the corner store out of business. I think PillPack and those sorts of services are probably definitely worthy of their attention, worthy of your attention as an analyst. But in the end, I think the insurance companies and their local relationships need to be vetted a little closer before you make a final decision on CVS.
I get that. I think one of the major things for me kind of that I was thinking of also with, like, you were talking about the technology thing, not only with like PillPack, but like with the Minute Clinic and stuff like that, is a lot of these people, especially now with COVID, if they can get, I feel like if you can get an over the phone call doctor's appointment or a video conference with a doctor's appointment, which I've personally done before, or even just using PillPack to get this prescription where you literally don't even have to leave your house. I think that is something that could, I'm not saying it would knock it out completely, but I definitely do think it's going to hurt CVS in some sort of the way, just especially because of the overall fear of what we've just been through this pandemic. And especially for some of the elderly folk that don't want to go out and do those things, they have that option. So I feel like that would be something that could definitely hinder it, but definitely I don't think it would knock it off its feet, but definitely would bring it down a little bit, I think.
Yeah, I think to your point about the impact of COVID, one thing that I think is a little tougher to wrap your mind around is the fact that because people were afraid to go out, a lot of them didn't even go to the doctor when they might have needed, especially minor procedures or checkups. But I think a lot of that actually impacted negatively the local drugstore as well. So, some of the numbers we're looking at are probably a little weaker than we would normally see, and might take some time. And to your point, I think a lot of these old traditional type retailers have been way too slow to embrace technology. And I think that's a valid point. But again, I wouldn't throw them away until I looked a little deeper into their relationships with insurers.
I agree, and also they could come up with something. They could come up to a point where they could maybe copy what PAC is doing as well, or have an online virtual thing as well. So if they were able to do something like that, it could bounce them back. So it's just kind of waiting to see how they want to innovate their company, I think.
Yeah, I mean, think about it. It's as easy as what we're doing right now. Last year, this time, we wouldn't have met online. And you could actually use technology that's available in the market and do the same thing that telehealth is doing.
Absolutely.
Yeah. All right. Well, I think you guys did a good job. But again, that one nuance I think should be checked.
Okay.
Yeah, and thank you for that, Troy. I think Josh has one last question, but before that, I'll throw in my quick 2 cents. As far as I've looked at CVS a little bit here and there, so I can maybe add a little fill in the blank a little bit. But the inventory thing on Walgreens, I believe a lot of that's just the cigarettes that they sell. So that makes that a little deceiving since CVS doesn't sell it. And I think CVS is a bit of a tricky company once you get into it, especially because they have so many unique relationships with insurers. I don't know how PillPack works 100%, but I know a lot of people have to pay out of pocket for it. So I'm not sure how that's going to transition quickly in the future. And CVS, I believe, spends quite a bit of money lobbying against stuff like that. So that might be a bit of a harder competitor. But Josh, go ahead and wrap it up for us.
Yeah, I have a quick question. So you're saying telehealth, PillPack, and Amazon, these are the main companies that are kind of killing off this industry?
Trevor, you want to say anything on that?
Yeah, I believe so. I mean, the contributors for the dip we see.
I think that, and like the grocers in like the pharmaceutical areas, just because if you're at the grocery store and you can pick up your prescription at the same time, you can kind of kill 2 birds with 1 stone, rather than going to a Kroger and then going to your Walgreens or going to your CVS or something like that. Which Trevor talked about a little bit, is just kind of having that convenience of having everything in one place, with places like Publix and your Krogers and your Walmarts and stuff like that.
All right, thanks.
Okay, and thank you for that. I know that was a big set of tough questions. But that pretty much wraps up the meeting. I have a few last minute things I want to say. So thank you to Troy, to Professor Gar, and Professor Karyaharan for joining us and giving us your feedback. As far as what happens with the current holdings, I believe David will be looking into that this week or the next. And within that time frame, we'll have an idea of what we're planning to sell and what we're planning to buy. Analysts, I know this was a rough week, rough time switching sectors and just a short timeline, but I'm really impressed with what you were able to get done. I know I sat in it at a few of the sector meetings, and I can tell you really put in the extra work to wrap it up before the main meeting. So I really appreciate that. That's about everything I have. Just want to emphasize again that I think it would be great for everyone to get in and use the Bloomberg terminal for the next pitch. And we're going to have the sign-up sheet is live right now. But if you can't make it, or if you have any other questions, feel free to message me, Rachel, or Kaylin, or anyone in management. We'll be happy to help you. And that pretty much concludes the meeting. So everyone's feel free to go. And thank you again for coming, and thank you for all the advisors for spending your time here and giving us the valuable feedback.
Great job, guys.
Thanks for having me. You guys take care.